Usually when you think about plumbing, there is a certain predictable logic to it.
Right.
Like water flows in, water flows out.
Right, exactly. It makes sense.
Yeah. And if there's a clog somewhere in your house, you just find it, you snake it, and the system works again. It's physical, it's visible, and you can fix it.
It basically obeys the laws of physics.
Yeah.
I mean, you locate the blockage, you remove the obstruction, and then the pressure in the pipes normalizes almost instantly.
But then you look at the global financial system in the fall of 2008, and suddenly the water just completely stopped flowing.
It just froze.
Right, the pipes were entirely blocked, but nobody could actually see the clog.
Yeah.
Nobody knew exactly where the blockage was located, and worse, nobody really knew how to fix it without, ripping up the entire foundation of the global economy.
Which is terrifying when you think about it.
Absolutely. So, welcome to the deep dive. Today, we have a massive, dense, incredibly detailed Wikipedia article in front of us covering the Troubled Asset Relief Program. You probably know it simply as TARP.
And our mission today is to cut through all of that really dense 2008 financial jargon. We want to figure out exactly what the U.S. government did with hundreds of billions of taxpayer dollars.
Yeah, and whether it actually worked.
Exactly. Did it work? And what does it really mean for your understanding of how the modern global economy is basically held together in times of absolute crisis?
Okay, let's unpack this, because before we can look at where the money went and the immense controversies that followed, we really have to establish what this money was actually supposed to do when it was signed into law.
Right, the original intent. We're talking about the Emergency Economic Stabilization Act of 2008, which was signed by President George W. Bush in response to the whole subprime mortgage crisis.
And originally, this legislation authorized a staggering $700 billion.
$700 billion.
Yeah, though it is worth noting that the Dodd-Frank Act later reduced that authorization down to about $475 billion. But still, at the time, in the heat of that 2008 panic, the sheer scale of the proposal was completely unprecedented. I mean, the government had never attempted an intervention of this magnitude before, and the original goal was right there in the name, right? The Troubled Asset Relief Program.
Exactly. The government wanted to purchase troubled or toxic assets, specifically things like collateralized debt obligations or CDOs that were originated on or before March 14th, 2008.
Which was the date of the Bear Stearns bailout, right?
Right, exactly.
Let's pause for a second, because we hear the term toxic asset thrown around all the time. But for someone listening who, doesn't work on Wall Street, what exactly was a CDO in this context, and why did it become toxic?
Well, a collateralized debt obligation was essentially a giant blender full of mortgages. Wall Street would take thousands of individual home loans, blend them all together into a single financial product, and then sell slices of that product to investors around the world.
Okay, so it's a bunch of mortgages mashed together.
Right. But the problem was that by 2008, many of the mortgages in those blenders were subprime, meaning they were given to borrowers who were highly likely to default.
So when housing prices started dropping,
People stopped paying their mortgages, and the value of these giant blended products completely collapsed.
wow. But the working hypothesis at the Treasury at the time was that these assets were being oversold because everyone was just in a state of sheer panic, right?
Yeah, the reality, at least according to our sources, was that only a small percentage of all mortgages were actually in default. However, the prices of these assets were falling as if the default rate was massively higher.
So the fear was basically spreading faster than the actual foreclosures.
Exactly. The market had completely lost its ability to rationally value these really complex securities. Nobody knew exactly how many bad mortgages were hidden inside any given CDO, so buyers simply went on strike.
They just stopped buying.
Completely. So the value of these assets on the bank's balance sheets plummeted to near zero, simply because there were no buyers.
So going back to our house analogy, instead of thinking about the government buying a clog and just pulling it out, think of it like this. The government was acting like a massive, deep-pocketed municipality.
I like that.
Yeah, because the banks couldn't flow cash, meaning they couldn't lend money to consumers or businesses or even each other because their pipes were severely damaged and just stuffed with these bad mortgages.
Right.
So the government was trying to step in, buy those damaged pipes themselves, and replace them with brand new, clean pipes made of pure cash just so the lending could flow again.
What's fascinating here is how they actually planned to do that. The Treasury faced this incredibly difficult issue. how do you price something that nobody wants to buy?
Yeah, how do you price extremely complex, unwieldy instruments when a market basically no longer exists?
Exactly. Because if you pay too much, the taxpayers get completely ripped off. But if you pay too little, the banks are forced to lock in massive losses, and you don't actually help them stabilize their balance sheets.
So the Treasury intended to use what's called a reverse auction. I want to make sure we really understand this mechanism because in a normal auction, you have one item and a bunch of buyers bidding the price up. How does a reverse auction work here?
Theoretically, a reverse auction uses market mechanisms to drive the price down to a fair level. In this scenario, you have one buyer, the U.S. government, and a bunch of sellers, which are the banks holding these toxic assets.
Okay.
And the banks desperately need to get these assets off their books and get cash in return. So the government asks the banks to submit offers for the price they are willing to accept.
So the competitive bidding process forces the banks to underbid each other just to guarantee they get chosen by the Treasury.
Right. And the government buys the assets from the lowest bidders first.
I mean, it sounds incredibly elegant in theory. The government runs an auction, the banks compete to sell their bad assets at a discount, the damaged pipes get removed from the system, and eventually the government might even sell those previously toxic assets back into a recovered market for a profit.
Yeah, that was the idea that was pitched to Congress and the public. But very quickly, harsh mathematical reality set in, which forced a complete abandonment of the core premise of TARP.
Yeah, the U.S. government quickly realized that buying up damaged pipes one by one using reverse auctions was mathematically difficult and, more importantly, just way too slow to stop a cascading global collapse.
They needed a new plan immediately.
And ironically, looking at our sources, this new plan came from across the pond. The original plan was entirely scratched when UK Prime Minister Gordon Brown came to the White House for an international summit.
Right, because the UK had just announced their own bank rescue package. And instead of trying to painstakingly evaluate and buy up toxic assets one by one, their model was just brute force.
Which was what?
Inject capital directly into the banks by purchasing preferred stock.
So the U.S. looks at this UK model and completely pivots. On October 14, 2008, the U.S. announced a $250 billion capital purchase program. They basically decided to use that first massive chunk of the TARP money to buy stakes in a wide variety of banks.
That was a massive shift.
Wait, I have to push back here. The entire legislation was sold to the public as the Troubled Asset Relief Program. So the government largely stopped buying troubled assets and effectively started buying parts of the banks themselves.
Yes. It was a fundamental shift in strategy, and there were a few critical reasons why this pivot was necessary to directly support bank solvency.
Okay.
First, as we discussed, pricing those toxic assets was just too hard and too slow. Taking weeks to run reverse auctions wasn't going to work when banks were literally on the brink of failing overnight.
Right, that makes sense.
But there was another highly technical problem that banking analysts like Meredith Whitney and other economists pointed out at the time, relating to stock volatility.
Wait, if you take the bad assets away from a struggling bank, shouldn't the bank's stock go up? Why wouldn't they want that?
You would think so, but distressed banks operate under very strange mathematical conditions. When a bank is teetering on the edge of bankruptcy, its equity is essentially acting like a lottery ticket.
A lottery ticket?
Yet in financial terms, it behaves like a call option. For a lottery ticket to have a chance of paying out a massive return, it needs wild swings in the market. It needs massive volatility.
Oh, I see. So taking away the toxic assets actually stabilizes the bank.
Exactly. It lowers the volatility. And in the complex world of distressed banking, lowering that volatility perversely lowers the speculative value of the stock.
Wow.
Therefore, these distressed banks would never willingly sell their toxic assets at fair market prices because simply removing the risk would destroy their stock value. They would only sell at wildly inflated prices.
So the banks wouldn't sell the bad assets unless the government massively overpaid because just taking the bad stuff away would ironically hurt the bank's stock. That is absolutely wild.
It is. And beyond that twisted math, there was a pressing psychological issue driving the pivot. Overnight lending between banks had come to a relative halt.
Which is how banks survive day to day, right?
Right. Banks rely on short-term loans from each other to function on a daily basis, but they simply did not trust each other anymore. If a bank doesn't know what kind of toxic waste is hiding on the balance sheet of the bank next door, they just won't lend to them.
So buying equity-like, injecting cold, hard cash directly into these institutions by purchasing preferred stock was seen as the fastest possible way to inject trust back into the system.
Precisely.
Let's clarify preferred stock for a second. The government isn't just like going on a trading app and buying regular shares like an everyday investor, right?
No, not at all. Preferred stock is essentially a VIP status for an investor. It means that the government gets priority when it comes to being paid dividends.
Okay, so they're first in line.
Yeah, if the bank goes bankrupt and its assets are liquidated, the holders of preferred stock get paid back for the regular common shareholders. It was a mechanism designed to protect the taxpayers' massive investment.
Here's where it gets really interesting for you listening. Because if the government is suddenly using taxpayer money to buy up VIP pieces of private banks, you have to wonder what protections the taxpayers actually got in return for this massive intervention.
Right.
Because without context, it sounds like we just handed Wall Street a blank check to survive a disaster of their own making.
And it certainly felt that way to a very angry public, but the Emergency Economic Stabilization Act did have specific strings attached to protect the government's investment.
Let's walk through them. First, there were equity warrants. If a financial institution sold assets or equity to TARP, they had to issue equity warrants to the Treasury.
Right, which basically gave the government the right to purchase shares in these companies at a specific locked-in price in the future.
I like to think of the government here as a very aggressive angel investor. They aren't just handing over a rescue check. They are demanding a seat at the table. Non-voting usually, but still a seat, and a massive share of the upside.
Exactly. If the bank recovers because of the taxpayer lifeline and its stock skyrockets, the taxpayer gets to buy stock at the old low price and profit from that recovery.
Makes sense. What was the next string attached?
The second major string attached was executive compensation limits. For companies where the Treasury acquired equity through direct purchases, they had to eliminate compensation structures that encouraged unnecessary and excessive risk-taking.
So no more golden parachutes for executives if things go south. And there was a $500,000 limit on tax deductions for executive pay, right?
Right. They even included clawback provisions.
Oh, meaning if an executive got a massive bonus based on financial statements that were later proven to be inaccurate or deliberately false, the government could legally force them to repay that bonus.
This raises an important question, however. You have all these rules on paper warrants, pay caps, clawbacks, but how do you actually oversee a program of this scale in real time?
Yeah, we're talking about hundreds of billions of dollars moving at lightning speed into hundreds of different institutions.
It was chaos. The Inspector General of the Treasury at the time, Eric Thorson, initially called the oversight workload a mess. He pointed out the sheer impossibility of overseeing TARP while simultaneously handling audits of dozens of actively failing banks.
So Congress created SIGTARP to handle this, the Special Inspector General for the Troubled Asset Relief Program. Neil Barofsky was the first to hold the post, and their job was monumental.
It really was. They had to prevent fraud, conflicts of interest, money laundering, and collusion across an incredibly complex web of disbursements.
And the fraud wasn't just hypothetical, right? People actively tried to steal this money.
Oh, absolutely. By October 2011, SIGTARP reported more than 150 ongoing criminal and civil investigations, and they eventually secured 28 criminal convictions.
There was this one brazen case in March 2010 involving the former president of the Park Avenue Bank, a man named Charles Antonucci. Tell us how someone actually tries to defraud a historic government bailout.
Well, Antonucci essentially tried to trick the government into giving his struggling bank $11 million in TARP funds.
How?
The government required banks to have a certain amount of private capital to qualify for the matching TARP funds. Antonucci didn't have it. So he engaged in a complex round-tripping scheme.
Round-tripping?
Yeah, he took the bank's own money, moved it through various entities he controlled, and then deposited it back into the bank, falsely claiming it was his own personal investment.
Wow. So he lied to regulators to make the bank look healthier than it was just to secure the taxpayer bailout.
Exactly. But Sidge Tarp caught discrepancies, and he was actually the first bank president criminally charged in relation to the TARP program.
Okay, so the government is buying preferred stock. They have the warrants. They have the fraud investigators actively locking people up. But how did the broader banking industry actually behave once the checks cleared? Like, did the money do what it was supposed to do?
Let's look at the primary goal sold to the American people, which was lending. The whole idea was to get banks to lend to consumers, small businesses, and home buyers again. But a review by the New York Times of investor presentations and conference calls from bank executives found that very few banks actually cited lending as a priority for this money.
And that is the part that makes people's blood boil. I mean, one bank chairman, Alan B. White of Plains Capital, literally called the massive cash infusion opportunity capital.
Opportunity capital.
Yeah. He noted on a call, and I quote, "They didn't tell me I had to do anything particular with it. They viewed it as a no-strings-attached windfall from the taxpayers."
Which is incredible. Many strong banks actually use the taxpayer money for consolidation instead of lending to Main Street. They use the government funds to buy up their weaker rivals.
PNC Financial Services is the perfect example here. On October 24, 2008, PNC received $7.7 billion in TARP funds. Hours later, literally hours later, they announced an agreement to buy their longtime rival, National City Corp, at a massive bargain price.
So the taxpayer money directly funded a corporate takeover. Then there was the lobbying aspect. During 2008, companies that received bailout money spent $114 million on lobbying and campaign contributions.
Wait, so they essentially used taxpayer-backed stability to fund efforts to influence the very lawmakers who bailed them out.
Pretty much.
Unbelievable. And what about those executive pay limits we talked about earlier, the ones meant to stop excessive bonuses?
Well, Grafe Crystal, a former compensation consultant, called the limits an absolute joke. Wall Street simply found loopholes.
Because of course they did. If you can't pay a CEO a massive cash bonus, how do you get around the TARP rules?
You defer the compensation. Banks simply converted those multi-million-dollar cash bonuses into restricted stock units or other deferred assets.
So the executives wouldn't get the money immediately, technically abiding by the letter of the short-term cash limit.
Right, but they were still guaranteed massive payouts down the line once the government scrutiny faded. It just proved how incredibly difficult it is to regulate Wall Street compensation structures.
There's another deeply troubling consequence buried in our sources regarding who actually got access to these lifelines. A study highlighted in the text found that in the Community Development Capital Initiative program, a typical white-owned bank was about 10 times more likely to receive TARP money than a black-owned bank.
Even after controlling for other financial factors, yes.
Wait, we can't just skip past that. Why did that happen? We're just reporting what the sources say here, but what was the mechanical reason for that disparity?
It really reveals a profound systemic failure in how emergency bureaucracy functions. Larger, predominantly white-owned banks simply had better institutional access.
Like better connections.
Exactly. They had direct lines to Treasury officials, specialized lawyers on retainer, and the immense resources required to navigate the dense, complex TARP paperwork immediately.
And the minority-owned community banks.
They often serve as the primary economic engines for marginalized communities, but they were stranded without that same rapid access to the government apparatus. Bureaucracy in a crisis almost always favors the well-connected.
That's devastating. And as the broader banking sector stabilized, the well-connected banks started fighting back against the very protections the taxpayers demanded. The American Bankers Association actively lobbied Congress to cancel those equity warrants we discussed earlier.
They actually had the audacity to call them an onerous exit fee.
An onerous exit fee. I mean, to put that in perspective, if the government had simply canceled the warrants for Goldman Sachs alone, it would have amounted to a taxpayer subsidy to that one single bank of between $5 billion and $24 billion.
Thankfully, they weren't canceled. And even Goldman Sachs publicly stated later that taxpayers should expect a decent return on the risk they took.
But if you are listening to this, you have to be wondering something. If the whole point of TARP was to get banks to lend to consumers and small businesses, but the banks just hoarded the money, used it to buy each other, deferred their bonuses, spent millions lobbying, and left minority-owned banks behind, didn't the program fundamentally fail its primary objective?
Well, that is the great paradox of TARP. If you judge it strictly by the goal of stimulating consumer lending and helping Main Street in the short term, its execution was highly flawed. The money just did not flow down to local businesses and home buyers in the way it was advertised.
Right.
However, if we look at the broader existential goal, preventing a complete cascading collapse of the global financial sector, the program was achieved.
It stopped the panic.
Yes. It recapitalized the system, it kept ATMs working, it achieved its ultimate objective, even though the mechanics of how it did so heavily favored the biggest, most powerful players.
Which brings us to the final tally. Because despite all the outrage, the controversies, the hoarding, and the fraud, the ultimate financial outcome of TARP is entirely counterintuitive to what most people probably remember.
Yeah, the program essentially ended in December 2014, when the Treasury sold its remaining holdings in Ally Financial. And when the dust finally settled and the books were closed, the numbers were incredibly surprising.
Let's go through them. The government dispersed about $426.4 billion over the life of the program. But total proceeds, meaning money paid back through interest, dividends, and selling off those angel investor warrants, came to $441.7 billion.
Meaning on paper, the U.S. Treasury actually generated a $15.3 billion surplus.
A profit. And the breakdown of where that massive amount of money went is also really revealing. It wasn't just banks, right?
No, it wasn't. About $204.9 billion went to banks through the capital purchase program. But $79.7 billion went to automakers, specifically General Motors and Chrysler, to prevent the total collapse of the American manufacturing supply chain.
Wow.
And $67.8 billion went to the insurance giant, AIG, because their failure would have brought down the banks anyway. Plus, $45.6 billion was allocated for housing and foreclosure assistance.
So wait, the government bailed out Wall Street, saved the American auto industry from total extinction, and actually made a $15 billion profit at the end of the day.
Well, there's a very significant economic catch to that profit calculation.
Ah, there's always a catch. What is it?
The entire TARP program was funded by deficit spending. The government did not have hundreds of billions of dollars just sitting in a checking account. They had to borrow the money they injected into the system by issuing treasury bonds.
Okay, and borrowing money costs money.
Exactly. During 2008 and 2009, the interest rate on that newly issued debt was between 2 and nearly 4%. That means the cost to service the debt the government incurred just to fund the TARP program was at least $8 to $16 billion a year.
So what does this all mean? It's exactly like borrowing money on a high-interest credit card to invest in a friend's struggling business.
That's a great way to look at it.
Yeah, like sure, you might make a $15 return on the actual investment when your friend pays you back, and you can point to that and say, look, I made a profit. But if you paid $50 in credit card interest over 5 years just to get the cash to make the investment in the first place, your profit is entirely an illusion. The interest payments completely eat the games.
If we connect this to the bigger picture, the claim that the government explicitly profited from TARP is highly debatable when you factor in that massive cost of borrowing.
Yeah.
But the macroeconomic impact is undeniable.
Right.
In a 2012 survey of leading economists by the University of Chicago Booth School of Business, there was wide agreement that unemployment at the end of 2010 would have been much, much higher without the TARP program.
Historically speaking, how does this compare to other times the government had to step in and save the day?
We could look at the Reconstruction Finance Corporation in the 1930s during the Great Depression, where the government bought stock in about 6,000 distressed banks. When the economy finally stabilized, they sold the stock and roughly broke even.
Okay, what about more recently?
Or look at the savings and loan crisis in the 1980s.
Yeah.
The bailout cost of the S&L crisis amounted to about 3.2% of GDP, and much of that was never recovered.
Right.
Yeah, a 2019 study estimated that the total direct cost of all the 2008 crisis-related bailouts, including TARP, the Federal Reserve lending programs, and the Fannie Mae and Freddie Mac bailouts, was about $500 billion, or roughly 3.5% of GDP in 2009.
But TARP itself was different.
Yes. What makes TARP unique among these interventions is that on the principal investments made by the fund itself, the government actually got its money back. In the realm of massive government crisis interventions, getting the principal back is a remarkably rare feat.
As we wrap this up for you listening, diving into the granular facts of TARP really reveals something profound about how our modern economic system operates. Massive government interventions in a time of crisis are incredibly messy.
Highly messy.
They are vastly unequal in their distribution, often leaving smaller, marginalized institutions totally out in the cold. And the people who cause the problem, the executives chasing volatile returns, often end up benefiting the most from the solution.
It's true. And yet, mathematically and systemically, the intervention was successful in preventing a far worse outcome for everyday people. The absolute collapse of the global economy was avoided.
It's the ultimate double-edged sword of economic policy. The system survived, the ATMs kept dispensing cash, but the precedents set during those chaotic weeks in 2008 will echo for decades.
Absolutely.
Which leaves us with a final thought for you to mull over. We started by talking about plumbing. The government stepped in, acted as the ultimate plumber, replaced the damaged pipes with cash, and even managed to get their plumbing fee back.
Right.
But if the government has proven that it can and will step in with hundreds of billions of dollars to save too big to fail institutions from their own toxic pipes, What incentive do those massive institutions have to avoid making the exact same reckless gambles today? If Wall Street knows the deep-pocketed plumber is always on standby, does the success of the 2008 rescue virtually guarantee the next crisis? Something to think about.